Before we get into today's video, some regulatory compliance. My name is Andrew Alexander. I am Head of Investments for Three Counties, an independent financial advisor based in County Durham, England. This video is for anyone who has an interest in investing and investment markets, both retail clients with no experience of investing through to industry professionals who invest for themselves and their clients. As independent financial advisors and wealth managers, there is no commercial relationship between ourselves and today's guest. The purpose of this video is educational, and in no way should any of the content be construed as advice, nor is it an enticement to invest. Past performance is not a guide to future performance, nor a reliable indicator of future results or performance. The value of investments may go down as well as up and is not guaranteed. Therefore, investors may not get back the amount originally invested. And now, onto the video. Welcome everyone to another of our weekly investment manager videos, and many thanks once again for tuning in. The US markets have started 2022 in turmoil, and I don't use that word lightly. After leading global returns for, frankly, the last decade, if not longer. So, buy the dip or rotate? That is the question that I'm hearing from pretty much everyone in the markets these days. So to help us navigate both this question, the market, and possibly our own investment portfolios, I have huge pleasure in speaking once again to Richard DeLisle, legendary investor and manager of the VT DeLisle American Fund. But first, before we get into the content, if you haven't subscribed already, it would be marvelous if you could do. It genuinely does help us in delivering our weekly financial planning and investment manager content. So, onto the content. Richard, many thanks once again for joining us in these conversations. I'll start off with 2022, and yeah, it started off with a bit of a bang, certainly in the US market. What's been happening?
Thank you for having me back, Andrew. I'm very glad to be here at this really dramatic time. So we start off with the rotation against high growth funds continuing, as a big fear going into 2022 on Americans' minds was inflation, and it's been a well-placed fear. The inflation figures last week came in higher than expected, well higher than expected. And when you break it down and look at the components, they were well worse than expected. There was no good news about it at all. So this fear that interest rates are going up gets greater and greater, and that has been deflating the high multiple stocks. It's like the air has been coming out and will continue to. So it started with the very high multiple ones, and it's creeping up to the big safe or supposedly safe cash flow generators. And we've seen Facebook fall, we've seen Netflix fall. It's sort of creeping up to the untouchables. I think they've already made their peak.
Right.
For a number of reasons. I think things like Apple and Amazon and Microsoft, they've already made their peak. It's over for them. You won't lose much money, but you won't make much either.
Right.
Because there's a revaluation going on, there's a reset going on, because we're changing to an environment we haven't seen for many years of rising interest rates. Not many people remember those.
No, and again, we've had conversations before we started recording this, and it feels strange. It does feel strange because there seems to be this huge desire by a lot of people who've obviously made a huge amount of money in those very names for that to continue. You mentioned inflation, and obviously the last read was 7.5%, which is big by anyone's imagination. I think the highest since 1982. Are there any areas that will be beneficial for investors to allocate to if the Fed does action the hawkish approach that they've actually signaled, and then continue and push on through that?
So does anything benefit from a rising inflationary environment? Does anything benefit from a rising interest rate environment, which is coming along behind? And just to be really scary, Andrew, you mentioned that this was the highest inflation since 1982. Your pub quiz question is, what was the 10-year bond yield the last time inflation was at this level in February 1982? Because this time the bond yield moved from 1.9% to 2.0% on the news. Yeah. The last time inflation was at 7.5%, the 10-year yield was at 15%.
Wow. Okay. Yeah.
And that shows because in those days interest rates were high and they were bringing inflation down. Yeah. Now they're low in order to let inflation up. It's a different cycle.
Yeah.
But just to give the comparison, as because people lose a sense of perspective of what can happen here. But the answer to the question is, what can do well from inflation? Anything that can pass the price increases on, pass the parcel. You get that. You get more inflation, a higher price coming to you. You wrap on a layer. You wrap on your same margin. You pass it on,
right.
And so you benefit. That's bigger profits.
Mm-hmm.
So long as you're not caught at the end of the line where you find that you're a price taker,
yeah,
you can't pass it on.
Yeah.
So long as you're early up the chain, you're going to be fine. Now, that might sound terribly simple, but the market hasn't got it yet, because as the money has been coming out of technology, there's been quite a good run going on in consumer staples. I think that's a big mistake.
Mm-hmm.
The consumer staples, like food groups or supermarkets, whatever, these are the guys at the end of the line that are receiving the higher priced foods, and they are finding it difficult to pass them straight on to the consumer. They might do it at the moment because savings are high after the pandemic and so on. Historically, when there's been high inflation, these are the guys that get squeezed, and these companies are already quite expensive. So that is not a place to go, not consumer staples, but it's more further up the chain.
Right. Okay. So, like I mentioned, you run the VT DeLisle American Fund, small cap, probably an overlooked investment area, to be perfectly honest, certainly with regards to UK investors. What opportunities are you seeing specifically within your sector and within the fund?
Well, surprisingly for us, even though there's been such a dramatic price level of the big caps techs, the type of stocks that we're in, which is small value stocks, mid-cap value stocks, are at lower multiples than they have been historically. And this is borne out by our fund. Our fund is on 9 times trailing earnings.
Wow. Mm-hmm.
And it's growing its earnings. It's growing. I mean, earnings are going to be up, 15% or so this year. Our historic rating, if we take an average of the rating of the fund for the last 10 years, has been a PE ratio of about 14 to 16 on a trailing basis. Mm-hmm. And that's borne out in the market. Value remains cheap. We haven't seen a rotation into these type of stocks at the small cap level yet. Mm-hmm. So there remains an opportunity just on the cheapness of our situation. And those type of, and when you're talking about discounting PEs lower as interest rates pick up,
yeah,
that whole discounting arithmetic means that if you've got a lower PE to start with, you don't really get discounted so much. It's when you've got the PEs, the way high PEs, that this process of saying what price should I pay for a 10% grower, or what price should I pay for a 20% grower, that's when it crashes down on the high PE multiples. Mm-hmm. Mm-hmm. So there is opportunity, surprisingly, but not in the stocks that make up the great weight of this American market.
Yeah. And I suppose that's the question that everyone's looking at this moment in time, with the US market falling so dramatically. Where else to look? And would you agree that the main factor is looking at valuation at this point in time? Is that the great deciding issue of current markets?
Valuation is very important, and again, the point that you made, that the ability not to get caught out in a rising interest rate, rising inflation environment. Mm-hmm. Mm-hmm. That if you look at the things that are causing the inflation, and to be participating in those areas which are causing it. For instance, we've been we're well overweight in fertilizer stocks, for instance. Many different commodity type plays, and I can go on and on and on about different areas of primary producers, industrial companies, which are quite happy with this environment. So it's valuation, and it's also being in the correct position.
Yeah. Fascinating as ever, Richard. It's always great to talk to you, and especially against these market backdrops. As I mentioned before, we started recording, everything seems to be focused upon, the FANGs or whatever the acronym is that we use these days. Big tech stock, NASDAQ tends to dominate everything, but just by doing a little bit of research and looking a bit further afield, adding diversification, dare I say, to your portfolio could reap huge rewards in these most volatile of times. As ever, Richard, magic to speak to you. Thank you very much for your time today. You stay safe, and I'm sure we'll catch up soon.
Thank you so much, Andrew. See you soon. Bye-bye.